Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 5th of February. I'm Daniel Lam, your host for the podcast. Back in my 20s, my former manager described the political situation as a game of chess. But nowadays, geopolitics is more like an enhanced three-dimensional chess battle. Case in point is the reality check on tariffs, which we briefly touch upon this Monday. Now, Trump has a strong hand, given exports to the US account for 18% of Canada's GDP and 29% of Mexico's. So if the tariff were ultimately implemented, a 25% tariff against Canada and Mexico, alongside an additional 10% tariff on Chinese imports, this would raise the effective US tariff rate to nearly 10%, the highest since 1946. Now, does Trump have any incentive to change course on the tariff? Well, not in the near term. Trump has promised to shift the tax burden away from domestic income to foreign sources, with tariffs being an important element. Now, given the budget deficit is over 6% of GDP, he will need to rely upon tariff to some extent. Moreover, politically, the majority of US voters believe that the US loses more from trade than it gains, especially amongst the Republicans, where the gap is 3-1. So the next question is tariff a non-self-damaging weapon for the US to utilize? Well, the answer is not exactly. Most studies have found that the announced tariffs against Canada, Mexico, and China would reduce US real GDP by a fairly modest 50 basis points, while lifting consumer prices by 70 basis points. So therefore, in order to control the inflationary effect, Trump has been very vocal in expanding the supply in oil, an integral part of his strategy in this three-dimensional chess match. The shock is coming from the supply side. More than half of North American trade is in intermediate goods, with the auto industry in particular being highly integrated across the region. So a trade war would shake the supply chain that has been in place over many decades, leading to significant blowback to the rest of the economy. Therefore, the check and balance on Trump would need to come from the financial markets. Now, while the US is a fairly closed economy, 41% of S&P 500 revenue comes from abroad. And for the IT sector, that number is actually at 57%. However, Trump will not back off from tariff unless the stock market falls significantly. But the stock market will not fall significantly if investors continue to believe that a major trade war will be avoided. Now, rather, in the near term, investors may seek safe haven in bonds. US 10-year government bond yield is testing the 4.5% support level, which is showing a head and shoulders pattern, so therefore potentially opening its way to the 4.25% yield level. We also expect gold to be well sought after. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.